Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. There's a lot going on in the world at the moment, Nord Stream pipeline being disrupted, etc. Who could have done that? Everyone has a fantastic story about every other party, but I can't see any nation involved, the US, Russia, Ukraine, UK, whoever, benefiting from this having happened. Yet someone thought it was a good idea for them to do it. So we'll see. Who knows? We may never find out the answer to that question. It's supportive of oil to a degree, very supportive of natural gas prices, of course. Now, one thing to remember in the whole global natural gas scenario is that if it was running at full speed, the United States LNG system to supply natural gas to Europe could only at its best replace 20% of what was being supplied from Russia to Europe. So Europe is going to be in dire straits on the energy front. Don't think that, oh, you hear the US is going to help Europe, that solves the problem. No, it doesn't. Hence, all these nations putting in place already crisis plans, and in some cases, particularly in Germany, already limiting energy use, providing parameters to both industry, office towers for heating, etc. It's going to be a tough winter for Europe, which brings us to markets. Now, there's a lot going on, but the absolute number one main game is the stock market. The US stock market, the European stock markets, they are in trouble. And if you look at the price action the last few days, they just keep slip sliding away. Everyone who tries to buy ends up having to reverse out of that buying position if they're a short-term trader. If they've been long-term buyers, they're just watching their losses steadily grow. This is not a good economic environment, which I've gone over so many times. And now, for the first time, well, it was already on the cards, but for the first time, we have actual property home prices in the United States are actually now falling. Now, I think it's just the first little blip to the downside, and this is going to, really turn into quite the tsunami of downside risk for property prices in the US. You remember around this time last year, I was warning of a property bubble in the United States. The second great property bubble of this century was in its formation, that prices were stretching away from the underlying fundamentals of the property market, and eventually that price runaway would reverse and fall in on itself. We're really we saw price growth steadily faltering. Now it's in contraction, down in the latest data. So I think that's sort of when you put the pin, you just prick the balloon. That's what we have in the data. What we will see in the data is a total bursting of the bubble. This comes, think about this, lower property prices, property market stress as the Federal Reserve continues to hike rates aggressively, and mortgage holders are also squeezed by high food and energy prices, because people might say, oh, petrol prices have come down or gas prices have come down at the petrol pump in the US, but natural gas prices in the United States, even with their recent downward correction, are still double what they were last year. That's a huge impost on the US consumer, and the Fed is continuing to hike rates, and food inflation remains very strong indeed. And that whole inflation scenario in the US has turned into a very steady prices, wages spiral to the upside. The Fed thinks it can head this off with massive rate hikes. It sees itself as being a gladiator, slaying the dragon that is inflation with ever higher interest rates. We will get that job done. And they're missing the point. It's not like the 1960s or the 1970s. It's different. This is supply shock initiated inflation, which they let take hold. It's like letting a barbecue fire take hold in a national park, a national forest. You don't do it, but the Fed did. It just watched and said, oh, it'll burn itself out. Well, it didn't. And now they have massive problem because they have runaway inflation. They have a wages prices spiral. So they think if we just keep hiking rates, we'll stop inflation and then the economy over time will heal itself. That's not what's going to happen. What's going to happen is consumers and businesses are going to be hit by general broad inflation, still a highly dysfunctional labour market where the data, the numbers say, the Excel spreadsheet says full employment, but there are no workers for the jobs that are available. This is a dysfunctional economy. It's not a strong economy. We've got manufacturing going into negative territory, contracting. We've got services going into negative territory, contracting. Now we've got property prices beginning to fall on top of an already 20% down and getting much worse, probably going to go another 10 to 20% lower equity market. And the Fed wants to be hiking interest rates. Now that story can be applied to Europe, UK, Australia, a little bit Canada. It's mostly a Western problem. So the rest of the world is going to be hit by this. We have manufacturing slowing across Asia at the moment. Remember 1929, the lead indicator that 1929 was going to happen was that old-fashioned idea that slowing manufacturing is a problem. We've been seeing that in the United States and elsewhere in the world for some time now. Do not ignore manufacturing data. It may not be as sexy as what a crypto is doing on the day, but it really matters. It's a real indicator of consumer demand and what's going on in an economy. All of that data is very ugly for the United States and Europe and UK, and Australia's kind of holding up. And I said yesterday in a TV show, I'm not as confident of my recession call for Australia as I am for the US and Europe, but I really think we're going to see catastrophic economic outcomes in Europe, UK, and the United States. These economies have incredible problems, and Europe is further burdened by the energy crisis, the energy shortfall. And remember, it's not just because Russia turned off the tap, it's also because Europe refused supply. So, some of this is doing it to themselves, which that's a major political debate, which people have to tiptoe around quite a bit, but that's the economic reality. I see the stock market in the US, look, a lot of you weren't around in 1987, but in case you didn't know, the Australian stock market fell 50% in 3 days. Now, sounds like an ancient story, doesn't it? I'm not saying that's going to happen this time. What I'm saying, though, is there's plenty of scope for the US market, European stocks, Australian stocks to have a fast downside period. It may not be 2 days, might be 2 years, might be 2 months, might be 2 weeks, but there's going to be slippage to the downside. I will give you an important clue, though, for equities, but also very much so, this is more true about currencies at the moment. If you look at a euro dollar chart, an Aussie dollar chart, almost any currency in the moment, if you see them, go and have a look at them today. Look at what the 3-day high has been. If we ever get back above the high of the last 3 days in any of those currencies, we may be seeing a reversal in the US dollar. My suggestion to you is that won't happen, and the US dollar is going to get even stronger. Now, China is playing the competitive currency to support its economy game that Japan did so well at. Basically, Japan depreciated its currency 25%, no one complained. So China's gone, if that's good enough for Japan, it's probably good enough for us. So the yuan weakening is not bad for China, it's great for China. So we can expect them to just gently let that depreciation occur. So the United States is going to be caught then with a too strong currency, hyperinflation, interest rates going through the roof, which is what's driving the US dollar really, safe haven buying of its currency as the rest of the world begins to crumble a little bit, as I said, mostly Western economies. Good news for Asia. China will have slow growth, but it will be okay. Asia is a strong economic region in its own right. It did well, reasonably well in the GFC. It will do reasonably well this time around as also. What concerns me is that for the United States and Europe and Australia, this could be far worse than the GFC. So, still selling stocks, still selling euros, still selling Aussie, still selling sterling. I'm looking at buying oil. We'll see. But basically, it's a buy US dollar, sell stock story, pretty much the story of the year. I don't think it's over yet, particularly the stocks. The US dollar, it's getting a little bit different, not as clear cut, but I'm still bullish the US dollar. Stocks, still very bearish. I hope you can make the most out of all of this. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.